Guys, and welcome back to the next session for cost of equity. And we just understood how to calculate the WACC, also known as WACC, or in full form is also known as weighted average cost of capital. And now, what we are getting into is after understanding weighted average cost of capital, now we are getting into how to actually estimate cost of equity. We looked at how to get an estimate for preferred stock. We got an fair idea of how to get the cost of debt using those two approaches, right? And now we get into the most complicated part of it, which is filled with assumptions, is on cost of equity, right? Because it's not readily available. You have to really calculate that, right? So it's all assumption. No company has written in its cost of equity. They do not write a document on what my cost of equity is. That has to be actually inferred, right? So the three approaches that are there with us is the capital asset pricing model. The second is the dividend discount model, and lastly we have the bond yield plus risk premium approach, which is nothing but taking the whatever the bond yield the company has and then attaching a risk premium to it, right? uh, we generally do not use bond yield plus risk premium approach. We're not going to really discuss how to calculate that, but the first two approaches are pretty common, out of which also the capital asset pricing model is much talked about during specifically when you're modeling. And dividend discount model approach is based on the Gordon growth model. So we will discuss one by one each of them, and we're going to use a template and some real data to make it more useful and understandable, right? But at a very base level, what is the capital asset pricing model, right? So in reality, what you're trying to do with the capital asset pricing model is you're trying to calculate premiums, okay, over which the company is giving you return, right? So if you see the simple formula out here, which it says is this is the actual cost of equity, or you can say the expected return from a certain company that you might expect by investing in it. So it starts with the risk free rate, right? And then skip the beta for now and concentrate on the second part, which is the RM minus RF, right? So the RM means the return on the market portfolio, which basically could also mean a benchmark. So if we were talking about Infosys, we could either consider Nifty, right, Nifty 50, or we could consider also an IT index specifically, right? But we're gonna stick to the market portfolio, which is Nifty 50, right? Now that return, the average return on that, minus the risk-free rate. So what you are trying to do in the second part of this equation is trying to say that how much does the market in general give more than the risk-free rate, which is, for example, the government bond rates, right? Because that's ideally risk-free because there is no default risk in it, right? So that premium multiplied by beta. Now beta tries to check the sensitivity of a stock that you are trying to find the cost of equity for compared to the same RM or Nifty 50. So you are trying to plot these two stocks, right? Nifty prices and Nifty 50 prices and the stock prices, and then you're trying to check the sensitivity, and that is what is beta, right? So you're multiplying the sensitivity with the premium of the market and then adding the risk-free rate, right? So then finally it gives you an estimate of what should be the expected rate of return. So don't worry right now, we're going to actually calculate this. So this is going to stay with you for as long as you actually use capital asset pricing model. An example is given here, but we're going to skip that because anyways I'm taking a real life example. But you are free to practice this during the class or after the class referring to the example, right? Now, so this is where the definition is given. So this is the premium that I'm talking about. So if Nifty 50 gives 15% and the government bonds are 7%, right? So that basically means that you get a premium of about 8%, right? Now that's what is written out here, right? And we're gonna get into the actual calculation. And the second approach also we will be using the template, which is to use the Gordon growth model. Fairly simple. Only thing is you need to have these data with you, which is easy to find out using the annual report. And that is where the entire continuation of that has been given, but anyways we'll skip that. I'm just trying to go through the slide so that I'll just tell you what exactly we're going to do, and then we're going to calculate beta. However, in the presentation is not really shown how to calculate using real data. So what we're going to do is we're going to actually use the data, so it will be very clear. And then we're going to discuss adjusted beta or levered and unlevered beta, wherein if let's say if you were talking about an IT company which is not listed, then how do you find the beta for that? So we're going to get to that as well. And so this is the formula for the pure play method, which is the method of finding levered and unlevered data. And then finally ending with flotation cost is when you are raising new capital, you are employing an investment bank, so that investment bank obviously will charge some cost. So how do you adjust for the cost of equity in that case? So we will end with the flotation cost, and now let's flip it into the template. Okay, so I'll see you on the other side. All right, so now we are with the template here. Okay, I mean this is not possible to just explain it theoretically. You have to do practically, and that's when this actually seeps into the brains and it is actually retained, right? So the capital asset pricing model, I have written the initials data which will be required, which is the return on market, RF, RP and beta. Okay, so let's first go and find out each of these information. The most complex is going to be beta, but I'm also going to tell you how beta is actually calculated hands-on. Okay, so let's move into the beta sheet first, okay, because that is where all the information is given. Okay, and for your convenience, whatever the formula we're going to use, I put it to the right hand side so you can actually refer very easily. Okay, so what I did is I took Infosys and Nifty data. Okay, these are price data which you can easily get it in Yahoo Finance. Okay, now these are daily price data. Okay, so as I was discussing, beta is the sensitivity of Infosys versus the benchmark, which is Nifty 50, the market, right? So Nifty is the market. So for finding the sensitivity, we have to first find the percentage change. So you don't find the sensitivity of the price, you find the sensitivity of the change in the price, right? So what we're going to do is we're going to find out the percentage change out here. So it's very easy. Today's price by yesterday's price minus 1. It's just a percentage change formula. Okay, change formula, and let me put it into percentages, just increase the decimal places. And I'm going to do the same thing for Nifty, right? And as you can see, in the same day when Nifty dropped 1.10, your Infi dropped 0.36, right? And if you see the next day, your Nifty dropped 0.43, but your Infi dropped. So this is what we're trying to measure, right? If you have to quantify, and you can clearly see Infi tends to be less reactive to Nifty. Okay, so the impact is lesser if you see out here, right? So anyway, so we have to quantify that. So we can't really just talk jabber about it. We'll have to actually calculate the sensitivity in numbers. Okay, so I've got the percentage change out here, right? Now when we're trying to find the sensitivity using beta, we have to understand the concept of covariance. Okay, now for the sake of the calculation, what I've done is I've actually shown you the formula of covariance. So what it does, so let me explain you the formula. So this xi basically means each percentage change, right? This is xi. Okay, and you are reducing this with the mean. Okay, so you're finding out the difference between a certain data point minus the mean of that entire set. So mean of the average return, and then you're multiplying this with the same thing you're doing it for Nifty as well. So this is the individual daily Nifty percentage change prices, and this is the mean return of Nifty, and then you're dividing it by n, that is the number of observation. Since it's a sample, what you tend to do is just one adjustment in the denominator is just do n minus 1. That is just to remove the factor of one extra value. The reason why you do that is if you take the exact number, then you're basically saying this is the sample. So you just do n minus 1, which just signifies that it's a sample, it's not a population, right? Skip the correlation formula. Right now we don't want to get into correlation, but look at the beta formula. So then whatever covariance you get, you divide it by the variance of the market. Remember, the denominator will be the variance of the market, not the Infosys stock, and that will give you the beta. So this is the sensitivity calculation adjusted for the deviation of the stock, okay, deviation of the market. So let's go ahead and first do it manually, and then I'll show you how to use a covariance formula which is already there in the Excel functionality. Okay, so if you can see x minus the mean, right? So first we need the mean, so let's calculate the mean out here. So we're just gonna find out the simple average. So that's the, oops, I selected, do it again. So I think there's some value which I missed out here. Yes. So in this cases, when you have such stock, this can happen due to trading holidays, or maybe it is just because of one day wherein the stock price is actually not updated in Yahoo Finance. So what you do in those cases is just take the last day's prices, okay? So and just quickly check if you're getting a value error. All you need to do is just check if there are any days in which the prices are not updated. So if you can see here, this might be a holiday and Yahoo Finance has not actually captured. So this is the cleaning part of the data exercise. And in reality, when you do these beta calculations, it's all a different ball game compared to what you learn in the paper, right? In paper, this won't have ever been written. This is real life scenarios. Okay, so just quickly check if there are any gaps in the data. Okay, if I think that was it, and let's see if the value was, so the value got updated, right? Now do the same for Nifty. So you've got the mean, right? So this is your mean for Infi and Nifty. Now what we can do is we can find the change between a certain value minus the mean. Okay, so this is going to be a mean, and I'm going to put a rho dollar sign here. So that's the difference. Okay, and I'm going to just decrease the decimal places. We don't really want such a big value. Calculate it out here. And we're going to do the same thing for Nifty as well. So this minus, in fact, what we can do is we can just drag the formula here. It's going to automatically do that. Okay, and we create some space here, and let's just double click it. So it has calculated it for all the periods, right? Except that now we need to sum it, right? We need to sum that value, so find out the changes. Now if you see the formula out here, in the next part, what do? We multiply both of them, right? And then we're going to divide it by n. So we're going to do a summation of this. Okay, so first is multiply this. There you go. We're gonna add this up. It gives up about 11.9%. Now what we're gonna do is we're gonna divide it by n. But what we can do instead is, if you see, we got about how many observations? We got about 1, 2, 3, 2, right? So we're going to take 1, 2, 3, 1, right? So 1, 2, 3, 1, and that should give us the covariance. Now covariance is really not presented in terms of percentage, it is presented in terms of a number, and the number is really very small. So if you see out here, it's 4 times 0.97, and it won't really give you any inference. Okay, so you could have used a formula as well. So for example, you can use the covariance sample formula, and you can use the same thing is to find out. Now you will not take the difference between the mean, you will take directly the percentage change of the prices of both the series, right? So you took both the series and you got it, right? And if you change it to numbers, it will be very, very similar, right? If you see, it's almost same, right? In fact, it's actually same. So that's how you calculate. First of all, the reason why I showed you the manual calculation is because so that you understand what is covariance rather than just using the formula directly. So now once we have the covariance, right, we need to find out the beta. So if you see, if you remember the formula was covariance divided by, so we're going to write the beta out here. So this is our covariance divided by the standard deviation square of the market, right? So we need to also find out, so I'm going to just write covariance here first, and let me write variance of the market. So variance is nothing but standard deviation of the Nifty prices, the market prices, right? So this is my market and I square it, right? So that's my variance. And now if I just divide these two, I will get covariance divided by variance. So that's going to give me a beta of 0.71. So what it says is that, Infosys is 70% sensitive to Nifty, right? So that means when Nifty goes up by 1, right, let's say 10%, then 10% multiplied by 0.7 will be the Nifty sensitivity. So Infi will only increase by 7% instead of 10%. So that is what all beta talks about, right? So I'm going to end the lecture out here for beta. Okay, in the next part of it is when I will talk about calculating the CAPM. So I'm going to keep this video short so that now you understood how to calculate beta first, and the CAPM I will cover in the next lecture.